Have you ever felt like something just doesn't add up in the housing market? Home prices are still high, inventory is tight, and yet behind the scenes, over 1 million loans are in default. But you won't hear about it on the news. The US government and major financial institutions are working overtime to mask the reality of a looming foreclosure crisis. Instead of letting the market correct itself, they're using forbearance programs, extended loan modifications, and bureaucratic loopholes to keep homes from officially entering foreclosure. On paper, the numbers look stable, but in reality, there's a backlog of delinquent mortgages just waiting to crash down. Why would they do this? Because admitting the truth could send shockwaves through the economy, leading to panic, plummeting home values, and another financial crisis like 2008. The difference is that this time it's happening in slow motion, behind closed doors. If you're a homeowner, a renter, or someone considering buying in this market, you need to know the real numbers. Because when the truth comes out, it could change everything. In this video, we're breaking down how the government is hiding foreclosures, why it matters, and what it means for your financial future. If home prices are so high, why are over 1 million loans in default? Do you think the government is covering this up to prevent a market panic? Drop a comment below and hit the like button if you joined the discussion. Before we dive into how the government is concealing foreclosures, let's first break down what's happening behind the scenes. A loan default happens when a borrower fails to make payments on their mortgage for an extended period, typically 90 days or more. When this happens, the loan is flagged as delinquent, and lenders begin the process of either restructuring the loan or initiating foreclosure. Right now, over 1 million loans are in default, but very few of them are officially being reported as foreclosures. This is because lenders and the government are using loan modifications, forbearance extensions, and bureaucratic delays to keep them off the books. But just because they aren't being foreclosed on yet doesn't mean the risk isn't real. Traditionally, once a loan is in default for an extended period, lenders file for foreclosure, a legal process where they reclaim the property. From there, the home is auctioned off or resold by the bank, often at a discounted price. But what happens when millions of loans are in default, yet the foreclosure numbers remain suspiciously low? The truth is, the government has been quietly stalling this process, keeping these homes off the market to prevent an economic fallout. But delaying the inevitable only makes the eventual crash far worse. The signs of financial distress in the housing market are everywhere, but they're not making the front page headlines. While the government claims the economy is strong, delinquencies and defaults are quietly piling up. One of the biggest warning signs is the rising number of mortgage delinquencies, especially among FHA loan borrowers, many of whom are first-time home buyers. In some areas, FHA loan delinquency rates are above 12%, meaning more than 1 in 10 homeowners with these loans are struggling to pay their mortgage. This problem isn't just affecting low-income borrowers either. Middle-class homeowners who bought at record-high prices in the last 2 years, often with adjustable rate mortgages, are now seeing their payments increase due to rising interest rates. Many of them can't afford the new payments, and yet lenders are delaying foreclosures instead of processing them as usual. Another hidden crisis: student loan defaults. With federal student loan payments resuming after a multi-year pause, millions of borrowers are falling behind, and their financial struggles are bleeding into the housing market. Many homeowners relied on the student loan pause to afford their mortgage payments, but now that payments have resumed, their budgets are being stretched too thin, causing a ripple effect of missed mortgage payments, credit card debt spikes, and personal loan defaults. With both mortgage and student loan delinquencies surging, the government faces a serious dilemma: let the market crash or keep hiding the problem. Right now, they're choosing to sweep it under the rug. If over 1 million loans are in default, why aren't we seeing a surge in foreclosures? The answer lies in the government's intervention tactics, which are designed not to fix the problem, but to delay it as long as possible. One of the government's biggest tools in delaying foreclosures is mortgage forbearance. Originally introduced during the COVID-19 pandemic, forbearance allowed struggling homeowners to pause their mortgage payments without penalty. While this was meant to be a temporary safety net, many homeowners never fully recovered financially, and extensions kept rolling out. Today, many of these forbearance programs are quietly being extended, even though they were supposed to expire. Instead of marking loans as delinquent or in default, lenders are working with the government to restructure them repeatedly, keeping homes off the foreclosure radar. But the biggest red flag? The government isn't openly reporting the real numbers. While mortgage default rates are rising, official foreclosure statistics remain artificially low. This isn't because homeowners have suddenly found financial stability. It's because the system is deliberately stalling the inevitable. By delaying foreclosures, the government and financial institutions can keep home prices from plummeting too quickly. If banks were forced to foreclose on these properties all at once, we'd see a flood of distressed sales, leading to a housing crash similar to 2008. But this delay tactic only buys time. It doesn't solve the underlying problem. Eventually, these loans will come due, and when that happens, the wave of foreclosures could be even bigger than expected. Delaying foreclosures might make the economy look stable on the surface, but beneath it, we're sitting on a ticking time bomb. The longer the government hides these defaults, the worse the financial fallout will be when reality hits. If the government is delaying foreclosures, what do you think happens when they can't hide it anymore? Will home prices crash, or will they find another way to keep the market propped up? Comment your thoughts below and give this video a like. Right now, the housing market remains artificially inflated. If millions of homes in default were suddenly listed as foreclosures, home prices would plummet overnight. Investors and home buyers would see massive discounts, but existing homeowners would lose equity fast, triggering a wave of panic selling. This isn't just speculation. We saw the same pattern leading up to the 2008 housing crash, where banks held onto delinquent loans for too long. When the dam finally broke, home values collapsed and millions lost their homes. By hiding foreclosures, the government is keeping inventory artificially low, making it look like there's a housing shortage. But once these distressed properties hit the market, expect a flood of supply that could send prices crashing down. The biggest risk? Banks and financial institutions. Many lenders have billions in bad loans sitting on their books, but as long as they can delay foreclosures, they don't have to report the losses. If the foreclosure wave hits all at once, we could see regional banks collapse, mortgage-backed securities lose value, and another financial crisis unfold. The Fed might try to intervene, but with high interest rates and economic uncertainty, there are fewer tools available to prevent a major credit freeze. Simply put, the longer the government tries to hide this crisis, the harder the crash will be when it finally unfolds. History has shown us that when foreclosure numbers are manipulated or hidden, the consequences can be devastating. Let's look at past incidents and what experts are saying about today's situation. A similar playbook was used during the 2008 housing crash. Before the market collapse, banks and government agencies delayed recognizing bad loans, hoping that economic conditions would improve. When the truth finally surfaced, home values plummeted by over 30%, and millions lost their homes. In 2010, the robo-signing scandal revealed that banks had rushed foreclosures without proper documentation, leading to widespread fraud. The government responded by slowing down foreclosures, but that only prolonged the pain for struggling homeowners and the economy. Today, we're seeing a modern version of this crisis with mortgage defaults piling up silently behind closed doors. Economists and housing analysts are already sounding the alarm. Mark Zandi, chief economist at Moody's, has warned that mortgage delinquencies are rising at a concerning rate, particularly among low-income and first-time buyers. Rick Sharga, a real estate market expert, says that while foreclosure filings are low right now, it's not because people aren't in trouble, it's because banks aren't filing the paperwork. This means we could be facing a delayed tsunami of foreclosures, and once it starts, the market could flip fast. With foreclosures being deliberately hidden, the housing market looks more stable than it really is. But when the truth comes out, homeowners and buyers need to be prepared. If you own a home, especially if you bought at peak prices, be aware that your property value could drop suddenly once foreclosures hit the market. If you're struggling with mortgage payments, don't wait. Talk to your lender now about refinancing or restructuring options. If the government can't hold off the wave much longer, expect price drops and equity losses in high-risk markets. Selling before the crash might be an option if you're in financial trouble. If you're thinking about buying a home, be patient. When the hidden foreclosures finally surface, home prices could drop significantly, meaning better deals for buyers in late 2024 and 2025. Instead of rushing into an overinflated market, watch foreclosure trends in your area. If a wave of distressed properties hits, you could get a steep discount on homes that are currently overpriced. The truth is, the housing market isn't as stable as it seems. Over 1 million loans are in default, but instead of addressing the issue head on, the government and banks are delaying foreclosures to avoid a market crash. This isn't a long-term solution, it's a ticking time bomb. When these hidden foreclosures finally hit, we could see plunging home values, financial instability, and another housing market shakeup. If you're a homeowner, stay informed and plan ahead. If you're a buyer, watch for market shifts before making a move. The real estate landscape is about to change, and those who are prepared will benefit the most. What do you think? Are we on the verge of a hidden foreclosure crisis, or will the government keep kicking the can down the road? Drop a comment below with your thoughts. If you want to stay ahead of market shifts, like and subscribe now.